So the Quad has a lot of work ahead of us. It's, the fact of the matter is that we have a lot of work to do, keeping this region peaceful and stable, tackling this pandemic and the next one, and addressing the climate crisis.
In the States, it's much more about rates because there's more resiliency in the economy, in the labor market, in the consumer. The consumer is sitting there on $3.4 trillion of deposits. Coming into COVID, they were sitting on $1 trillion. So there's some buffer there.
I think the responsibility for inflation is squarely with central banks. And to the extent that they're able to exercise that responsibility, there will be higher interest rates, and that will lead to lower economic growth. I think that's inevitable.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition on this Tuesday, 24th of May. I'm Francine Lacqua here in Davos, and here's what's coming up on today's program. ECB President Christine Lagarde rejects the idea that the euro area is heading for a recession. She tells us that the central bank is not in a panic mode. The rally snaps. U.S. futures slide after Snap slashes its profit forecast. Jamie Dimon says storm clouds hang over the U.S. economy, but that may dissipate. And hike first, ask questions later. The Fed's Raphael Bostic says a pause may be needed after 2 more half-point increases. Esther George says get to 2%, then see. Well, good morning, everyone. A little bit of a subdued mood here in Davos. So all of the chief executives we speak to worry about inflation. They worry about the future, especially in the next 8 to 12 months. Now, this is a picture for markets across the board. Stocks declining after a profit warning from Snap. Weight on technology shares, also fueling concern about risks to economic growth. In fact, if you look at the European stocks, tech shares among the worst performers. Chinese stocks actually also fell, tumbling by more than 4%. Now, oil and the dollar also down. Treasuries actually advancing. The euro, very, very interesting to look at what the currency is doing. The euro climbing above 107 for the first time in 4 weeks, as the ECB President Christine Lagarde said the currency bloc had reached a turning point in monetary policy, and she rejected, of course, the idea in an interview on this program that the region is headed for a recession. When you look at the European map, again, Europe's 2 largest economies keep growing in May. They benefited from a sustained rebound in services that offset the fallout from Russia's invasion in Ukraine. You don't really see that playing out on today's share price. Overall, we're seeing quite a lot of pressure on these European stocks. Let's pivot to tech. Snap shares slumping 30% in pre-market trade after cutting earnings forecast for the second quarter. Now, that will have probably a ripple effect to a lot of the other tech stocks. Snap just opening pre-market down 31%. That's a third of its value just being wiped off like that. So let's get straight to Laura Wright, who talks about, of course, Snap and all things tech. Laura, what did we learn overnight?
Well, it was brutal in after-hours trading, Francine, and it's equally as red this morning in pre-market trading. We learned at the end of the last earnings presentation from Snap, they were projecting revenue growth year over year of between 20 and 25% for the upcoming quarter, along with adjusted EBITDA of between break-even and $50 million. Now, in a letter to employees from Evan Spiegel, Snap's founder and CEO, he said that they're likely to fall below the bottom end of those forecasts. The challenges that Snapchat are facing, not unique: inflation, interest rate hikes, supply chain congestion, labor disruption, and those Apple privacy changes. Now, against those myriad of headwinds, it means that advertising revenue is at risk, which is a problem for social media companies that rely on advertising revenue, such as Snapchat, Meta, Pinterest, in this environment.
So what's the outlook for growth names?
It's pretty bleak, Francine. So far in 2022, U.S. value has outperformed U.S. growth names for the first time in 15 years. Why? Because of turbocharged interest rate hikes from the Federal Reserve, the start of quantitative tightening in June. In fact, the NASDAQ 100, only 12% of stocks are trading above their 200-day moving average. Investors have little tolerance for losses right now, and highly valued tech names such as Snapchat, which currently trades on 51 times forward earnings. Francine.
Laura, thanks so much. Laura, right there with some of the tech names. Now, the European Central Bank will not be rushed into withdrawing monetary stimulus as officials act to contain inflation, running at almost 4 times their 2% target. Here's what Christine Lagarde had to say in our exclusive conversation earlier at the World Economic Forum in Davos.
We are not in a panic mode. And we've started that journey, thinking about it very carefully, back in December, with steps along the way. And we are now at a stage where there is every certainty that we will stop net asset purchases very early in July.
Let's get into the key market drivers now with our markets reporter, Justina Lee. Justina, what are you seeing?
Yeah, I mean, today, traders are looking at the effects from China's stimulus. Of course, we've been waiting for this package for a long time, but it has turned out to be pretty disappointing, judging from the reaction in the stock market. It seems like there are still not a lot of support for consumers, and of course, at the same time, let's see if the dollar is peaking. After that interview you did, because we do see the euro strengthening now that it seems like the ECB is finally catching up on the monetary tightening front.
Yeah, Justina, I mean, tech stocks are getting really slammed. Are we going to have to work our way through until we have valuations that make more sense if we have to deal with inflation?
Yeah, I think that's part of it. I think what people are taking away from the snap warning is, tech stocks are not as immune as we previously thought from these macro headwinds. And that, of course, for a long time was what people had thought. And at the same time, there's also the interest rate factor. Tech stocks kind of rely more on long-term cash flows, which are discounted at higher rates now that interest rates are going up.
Justina, thanks so much. Justina Lee there with the main market movers. Now, coming up, we speak to Banque de France Governor Francois Villeroy de Galhau right here in Davos. That interview is next, and this is Bloomberg.
We are not in a panic mode. And we've started that journey, thinking about it very carefully, back in December, with steps along the way. And we are now at a stage where there is every certainty that we will stop net asset purchases very early in July. We don't have that as a baseline. You must have heard that sentence a million times, which is why we also do scenarios. And we have the negative, the adverse, the various alternatives there on the basis of hypotheticals such as boycott of oil, interruption of gas supply that clearly would have a significant impact on the economy. But for the moment, we are not seeing a recession in the euro area.
Well, that was Christine Lagarde speaking to us a little bit earlier this morning. Now, to continue the conversation on inflation, growth, Europe, and the challenges of being a central banker right now, we're joined by Francois Villeroy de Galhau. He's a Banque de France Governor. So, Governor, thank you for joining us.
Please, good morning.
It's not easy. And when you're looking at the trading floor, a lot of the markets, there does seem to be this idea that actually central banks are sitting at their table, they look at growth, they look at inflation, and somehow they have to choose between the two.
I don't buy this idea of a trade-off, and I would play it down. First, we have a price stability mandate, and this is the first threat we have to deal with, growing inflation. By the way, it's also the first worry of our fellow citizens in each European country. But let me elaborate somewhat. First, when we look at activity, it's still resilient in Europe. We see it in Germany, in France. We will still have significant growth this year. Second, and this is for me very important, it will be a normalization of our monetary policy. It's not a tightening. Let me explain. Let me explain, Francine. This is very important. We had a very accommodative monetary policy due to missing inflation. What we do is releasing the accelerator at this stage, stopping net asset purchases, exiting negative interest rates, until the neutral rate. We are not yet at the neutral rate. We are maintaining an accommodative monetary policy, but less so. The question of tightening could come later when we are at the neutral rate, sometime next year, I would say. But we are not yet there. It's about normalization, and this is for me important. Let me add one thing about growth. everybody cares about growth, and rightly so. But if you look at growth now, what is missing is not demand, it's supply. Look at bottlenecks, look at labor markets problem, look at climate transition, digitalization. So it's about supply side policies. And monetary policy is not responsible for that. I think it's fully consistent to give the priority to the fight against inflation.
Yeah, and I understand that you're normalizing, but actually we've been in this, for such a long time that a lot of markets, a lot of traders, even a lot of chief executives can't remember what it was like pre all this free cash out there in monetary policy. Is that a danger that actually we can't remember what it was like before the ECB, put the economy on life support?
If you allow me a smile, some central bankers are old enough.
No, you're too young for that.
To remember the old days of inflation. So no, and we have an economic and monetary track record, so we shouldn't have short memories. I agree with that, but I don't see it as a huge danger. We should explain, obviously. It's what Christine Lagarde did yesterday. Yep. And Christine Lagarde expressed an increasing consensus in our governing council. It was not by chance that she gave this blog. I like to think about a roadmap for our normalization. Yes. It's not only the start of the journey, which since yesterday is much clearer. It's about two next steps which are very important, to be at the neutral rate sometime next year, and very important, in 24, to be back at our target. We will bring inflation back to 2% within 2 years. This is very important.
Where do you see the terminal rate for the euro area?
I don't know yet. Let me be precise about this neutral rate step. We should probably go to the neutral rate till next year. The pace will depend on actual inflation and activity data. I'm open about the space. And then we will see, is it sufficient to bring our inflation back to 2%, as I mentioned, in 24? Or should we go beyond the neutral rate? We will assess. This is what we mean by optionality. Yep. We are on a clear course, and this is very important for market expectations, for households, for firms. We give a clear direction, but we are not pre-committed. And this is what we will assess next year.
So what does that mean, for example, for a 50 basis point hike in July? Is that still possible?
Christine Lagarde expressed a consensus yesterday. The 50 basis point hike doesn't belong to the consensus at this stage. I'm clear. But we are determined in this direction to give a magnitude about the neutral rate. Nobody knows exactly where it is, but if I think in real terms, in the euro at least, probably between -1 and 0, which means in nominal terms between +1 and +2. But we'll see exactly.
How much does an ECB hike affect economic activity in euro?
As I said, this idea of a trade-off with economic activity is not that relevant, at least in the circumstances.
But it must have a small impact, or an impact.
No, it could have an impact, but there are other channels of monetary policy. One very important one is re-anchoring expectations. And this is our first priority, and we are extremely clear about that. Again, the challenge of economic activity, if you look in the US or in Europe, is not mainly a challenge of demand. It's a challenge of supply.
And Governor, you're pretty confident that actually in the second, third quarter, we're not going to see a contraction in the European economy?
We'll see exactly where we are, but if I look at France or Germany, but let me speak about France, which is the country I know best, and which, by the way, is interesting because it's a proxy for the euro average. We expect a growth this quarter, this second quarter, of 0.2%. It's moderate, but it's still positive. And for the whole year, we could have a significant growth. We had one of our forecasts in March was 2.8% for the whole year for France. We will publish our forecast next month, but we shouldn't be too far from that figure.
Governor, how much do you look at spreads between European yields?
This is an important point. We will go along normalization, but we will fight unwarranted fragmentation. And this is about the normalization is about the monetary stance. Fighting unwarranted fragmentation is about monetary transmission. Right. And we look at both. We are determined to fight, if necessary, unwarranted fragmentation. We did it in the past with success. Think of March 2020 with the PEP, and there were other tools in the past. Think of 2012 also. So we have the will to act, and we have the capacity to act if necessary.
And you think is that your base, that there will be some kind of dislocation in the market as you start to normalize?
We will not give thresholds, but nobody should expect the ECB to be absent if in case of fragmentation. We said it very clearly in our December monetary policy statement. Flexibility belongs to our monetary policy.
Governor, Christine Lagarde was very clear, no more negative rates from September. What happens next?
As I said, I think the next step is next year to go towards a neutral rate, but the calendar will depend on actual data. And I think this is a very logical step. We shouldn't think that unconventional monetary policy and very accommodative policy, which was warranted in the past, let's say in the last 5 to 6 years, because we didn't have enough inflation, is a normal monetary policy. Normalization means a very simple thing. We go back to a more normal monetary policy associated with our inflation target of 2%.
So interest rates higher is what you're telling me. This is normal. This is the new normal.
Interest rates less low, if I may stress it, but no, it means a very simple thing, also for households and firms. Interest rates were exceptionally favorable. They will be less so in the future. But if you compare with normal conditions meaning historical average, for example, they will remain favorable, and interest rate hikes will be gradual.
Governor, as always, thank you so much for your time today. He is Francois Villeroy de Galhau, the Banque de France Governor. Now, with that, of course, we'll have plenty more interviews throughout the day. We'll have more from our exclusive interview with the UBS Chief Executive, Ralph Hammers, from Davos. That's coming up next, and this is Bloomberg.
What you see at this moment, because it is unclear, is that they stay invested, but not more money is coming into the market. So they are sidelining the money.
Ralph, is when you earn your fees, right? This is like, is active management back? Is this the only way to make money in the next 12 months?
Active management only happens when there's also transactions, right? So it's and if there's no transactions, so if they're not investing, then the money will not flow. So, but I do think that this will not last for long. I think in the next 3 months there will be much more clarity coming through as to the direction. And it's clearly a couple of things. We just went through, we had to digest 3 major shocks, right? The pandemic shock, the war shock, and the energy transition shock. So supply shocks, demand shocks, all together mixed in one. Of course it is unclear at this moment in time. So we'll have to kind of figure this one out, find bigger steps to maneuver in order to settle. And we need clarity also coming from China. So, because that.
But interest rates are going up in Europe.
Interest rates are going up.
So that's helpful for you guys.
Absolutely, yeah. So it's the rates getting into positive territory is a good thing in my view. We can make bigger steps there. Real rates are still negative. Therefore, I do think that from a policy perspective, it may not be as bad to make those moves, and it builds you a buffer for ammunition when you need it again.
Do you think you can take on like Wall Street titans in certain spaces?
On the wealth side, for sure, absolutely. I wouldn't know why not. We are truly the largest global network for private money, 4.5 trillion. There's only one. That's UBS. And it's not to brag. It's just what we are. The question is, how do you bring it together? And how do you make it interesting from all of your clients? So we're truly managing this as an ecosystem where we see Asian investment opportunities for U.S. clients, and we see Brazilian investment opportunities for Asian clients. We bring entrepreneurs together because entrepreneurs don't want to invest in public markets. Entrepreneurs want to invest in entrepreneurs.
Yes, and sometimes they have liquidity issues, so they need their bankers more than anything else. If you look at Europe, consolidation in Europe, would you buy anything in Europe?
I want to separate the question here. So consolidation in Europe, in the Eurozone, I think. I find it really difficult. I think that the SSM has done a tremendous job creating a level playing field. I think they should get much more credibility for and much more confidence from the local authorities in what they have done and built, also in terms of safety there. But as long as the local authorities sit on the capital, sit on the liquidity, there is not a lot of benefit for cross-border consolidation in the Eurozone.
Well, that was the UBS Chief Executive Ralph Hammers, who I was speaking to a bit earlier here at the World Economic Forum in Davos. Now, we'll have much more from Davos throughout the week. Now, let's do, of course, a data check, because the data usually tells a story as it is. A lot of pressure for some of the technology stocks. We saw Snap just 20 minutes ago, a pre-market open down some 30% after disappointing investors with their forward guidance. If you look at stocks around the world, but also U.S. futures declining because tech is sliding, the worst performer in Europe Stoxx 600. Then I'm looking at oil and dollar falling, treasuries advancing, the euro actually climbing to 107 after our Lagarde interview. We'll have plenty more, of course, with Christine Lagarde's and her perspective timetable for 2 quarter-point hikes. That's annoyed colleagues who want to move faster. This is Bloomberg. ECB President Christine Lagarde rejects the idea that the euro area is heading for a recession, telling us that the central bank is not in panic mode. The rally snaps, U.S. futures slide after Snap slashes its profit forecast, but Jamie Dimon says storm clouds hanging over the U.S. economy may dissipate. Hike first, ask questions later. The Fed's Raphael Bostic says a pause may be needed after 2 more half-point increases. Esther George says get to 2%, then see. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua for day 2 at the World Economic Forum here in Davos, Switzerland. So the ECB President Christine Lagarde spoke to us exclusively here at the World Economic Forum, and she told us that the bank is likely to exit negative rates by the end of the 3rd quarter. She does not see a recession at the moment for the euro area.
We have been going through 8 years of negative interest rates, special accommodation, and we are clearly now at a turning point. And I thought it was appropriate at this point to explain what the journey is, what the direction of travel is, what the destination is in the relatively short term, and what is our aim point as well.
If you're hiking, you want to hike, why wait for July?
We are not in a panic mode. And we've started that journey, thinking about it very carefully, back in December, with steps along the way. And we are now at a stage where there is every certainty that we will stop net asset purchases very early in July, deciding so in June, which will then clear the way for a rate hike that will come reasonably shortly after that.
So is there a danger that because of the timetable, which of course, goes to the credibility of the ECB, which is we do QE first or we unwind that and then go into interest rates, that you miss a curve of inflation?
I don't think so. I think that, anybody who is very careful about analyzing realizes that we are in a situation which is vastly different from that of the United States. And we are actually perfectly on time and not behind the curve. I think there is also great value in being steady, predictable, and we said all along in our forward guidance that we would stop quantitative easing in terms of net asset purchases, because we will continue reinvesting as we go, and that then we look at interest rates, which will be the main tool further on.
How do you see inflation developing from now? I mean, again, there's so many unknowns because of the war.
There are lots of forces, and some of them, counteracting against each other. You have the war, which in and of itself is an absolute drama and has massive economic impacts, not just in Ukraine and eventually in Russia, but for the rest of the world. We have energy prices, which have gone up significantly and represents a big chunk of inflation. We have food prices. I mean, there's a whole series of things that are weighing on growth down and pushing inflation up. But on the other side, you also have forces. You know me, I tend to be a positive person, and I try to look at what is likely to counteract those very significant shocks. there is unemployment which is at rock bottom rate compared with whatever we have measured in the last 20 years. We have massive savings that are still untouched. And we have, look around. There is a summer season that is coming up in Europe in particular, which is a destination of tourism by all accounts. Everything is chock-a-block in Europe at the moment. Try to book a flight, try to book a hotel room. It's completely blocked. And people are just catching up with what they've been missing. So services is recovering, and that is going to be one of the counter force that will act.
How likely is it that the Eurozone goes into recession?
We don't have that as a baseline. You must have heard that sentence a million times, which is why we also do scenarios, and we have the negative, the adverse, the various alternatives there on the basis of hypotheticals such as boycott of oil, interruption of gas supply that clearly would have a significant impact on the economy. But for the moment, we are not seeing a recession in the euro area.
ECB President there, Christine Lagarde, speaking exclusively to Bloomberg in Davos a little bit earlier on. Now, we're also getting some data out of the UK May services PMI falling to 51.8. The forecast was 57, so this is actually quite a big fall in terms of services for the month of May. Manufacturing holding up to expectations. 54.6 is what we got instead of 55 forecast. Now, this is my favorite part of the day. Forget the newsmakers. We love them, but there is one man who keeps the ship on the road. He keeps it together. He's our Bloomberg Senior Executive Editor for Economics, and he's in charge of our Davos coverage. So he's the guy you annoy to make sure that you get a good hotel room. Simon, thank you for joining us. Let's talk economics. We spoke to the French governor of the central bank. We spoke to Christine Lagarde. I mean, do the markets believe that, that 50 basis points is off the table and will be okay?
Well, it seems to be. Christine Lagarde obviously preempting her trip to Davos with that blog yesterday, which kind of set the scene. Bloomberg reporting late last night that some irritation among the hawks who feel now that they've been kind of bunched in. You'll remember when Mario Draghi ran the ECB, he kind of front-run his governing council. Christine Lagarde hasn't done that in the past. This week she has, and clearly the markets are responding to that. We've seen the euro strengthening, the dollar coming down. Nice piece from John Authers at Bloomberg today making the point this could be the peak of the dollar. But yeah, 50 does seem much harder to get now.
But so this is not about consensus, which is how the ECB are trying to say. And saying, yeah, we have consensus on the governing council. This was the right way to message to talk to the markets. This is actually Christine Lagarde taking control.
It would seem to be, and obviously they will talk about consensus. Remember that governing council was so big, so many disparate views, and occasionally, as with Mario Draghi during the crisis years, the president kind of takes everyone's scruff of the neck and says, this is how we're going to do it. There's a lot of questions, though, as you asked in your interview, why aren't they doing this in June? If they're so worried, why aren't they doing it in June? If there's all these clouds on the horizon, why are they painting themselves into a corner for September? So you can definitely say on both sides, like, why are you doing this communication? Yep. At the end of the day, the markets were looking for some more guidance. There was the Fed's been raising, the Bank of England's been raising, the ECB was starting to look behind the curve a little. And
then the French central bank governor, who was basically saying, look, there's no real trade-off between inflation and growth. Is there, though, there has to be some kind of trade-off. I know the ECB has one mandate, so they have to stick to inflation, and that's what hurts the cost of living most. But actually, they could do a policy mistake and hike too much.
Absolutely, and this is the real question for central banks going forward. And they've perhaps experimented on the other side of that equation in the last year, where the Fed, certainly, which has a dual target, the Fed was talking a lot more about labour market than it was about inflation, wanting to kind of make that a bit hotter than it was previously, and then they've flipped in the other direction. So you go too fast or you go too strong with your rate hikes, you were talking a recession next year. You don't do that, inflation carries on climbing, and you've got a bigger problem to tackle. So it's certainly for central banks at the moment, there's a real double-edged sword about just how they operate. At the moment, they're going with inflation.
Are you loving Davos without snow? Is it easier to send reporters out and get the stories?
It's definitely
just stressful?
It's definitely much easier. Fewer hospital visits and slippages, but the weather was lovely yesterday, very warm. Today a bit soggy.
What are you working on today? We have how many stories do we have out? Like 12, 15 a day?
Yeah, so we're driving coverage through the Davos update, which allows readers to find out very quickly what's going on here. Christine Lagarde and UBS, obviously the Bank of America CEO coming on later. So a great amount of people both on this stage and on the panels. The NATO chief also, and so we're excited to provide the print copy for your interviews.
That's my cue to get him off the set and back in the newsroom, because he has a lot of work. That was Bloomberg Senior Executive Editor for Economics, Simon Kennedy. Always fun. Coming up, Goldman Sachs Chief Investment Officer for Public Markets Equity, Kailey Leinz, live from the World Economic Forum in Davos. That interview is next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua, the World Economic Forum in Davos, Switzerland. Look at that. It's beautiful, even without the snow. Now let's get straight to the Bloomberg Business Flash. In London, here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Air France KLM is to sell more than 2.2 billion euros of new shares to shore up its balance sheet. The proceeds will be used to reimburse about 1.7 billion euros of subordinate bonds issued last year during the COVID crisis and held by the French government. The Dutch and French governments are both expected to participate in the rights issue to maintain their shareholdings. Social media stocks have taken a hit after the New York Bell as Snap cut its revenue and profit forecast below the low end of its previous guidance. The company says the macroeconomic environment has worsened further and faster than actually anticipated. Its second quarter forecast for 20 to 25% year-over-year revenue growth was already below analyst estimates. Airbnb is shutting its operations over in China, choosing to focus instead on outbound Chinese tourism, and as the country continues its aggressive approach to containing COVID-19. The short-term rental company is said to be planning to end its domestic offerings this summer, despite a big push on the mainland. China accounted for only 1% of Airbnb revenues, and that was over the past few years. And that's your Bloomberg Business Flash. Francine.
Leanne, thanks so much. Now let's continue day two of the World Economic Forum here in Davos to talk about markets, to talk about inflation, to talk about China, to talk about divisions in the world order. Kailey Leinz, Goldman Sachs Chief Investment Officer for Public Markets Equity. Thank you, Kailey, for joining us. So many questions. I want to talk to you about inflation and actually what you're seeing in the markets with China. But Snap, so Snap disappointed investors today. I think pre-market it was down 30%. I don't know if you have an update on that. Are we going to see much more of these stories where tech just needs to reevaluate where it's at?
Yeah, so last night they came out with a pre-warning, and it was very much associated with macro weakness and the fact that that would put downward pressure on advertising revenues. So there's a real risk to any of these social media platforms that are dependent on advertising revenues that they're going to face a near-term headwind. The other near-term headwind for tech, most of it's been priced into public markets, and actually we see a lot of opportunity, which I want to come back to. But the other thing that needs to play out before we get a full recovery here is private markets, which have not yet discounted the bad news that public markets have. That's still a couple of quarters away.
But so, Kate, is this a valuation problem, or is this really a forward guidance problem?
Very big picture for technology. I just want to be super clear that we're facing cyclical carnage at the moment in public markets. But the long-term opportunity here is actually exceptional. I think, in fact, if people step in here, the long-term opportunity is one of the best that we've had potentially ever.
So where do you see the value?
Yeah, so I think one thing I would say, just to give people a sense on valuations, to make people feel better that some of this has been priced into public markets already, is that it took energy 5 years to get the multiple cut in half. We've done that in technology in 6 months. So a lot of bad news priced in. In terms of where we see opportunity from here going forward, I would say, first of all, you have a secular opportunity. Actually, if you talk to any of these CEOs, and you've spoken to a lot of them, Francine, and ask them, are you planning on cutting your enterprise spend? No one's going to say yes. There is a secular commitment to spending on tech. If you're worried about inflation, you're going to invest in software, because that's one of the only deflationary things that you can do. You want to extend your competitive advantage, you need to invest in data, which is positive, obviously, for the cloud. And by the way, we know the geopolitical headwinds are very strong. You need to secure that data, which is very good for cyber.
Cybersecurity.
And then semis underlies all of that. So these are incredible secular opportunities that are 40 to 70% down on a share price and valuation, and therefore set up for good long-term returns.
I mean, the market last week certainly had a freak out on the S&P 500. How difficult is it to call it bottom for some of these equity markets?
So I would say we're much better at generating relative performance than making market calls, but I will make one for you, which is that I think the risks are skewed to the downside. So we're right on the precipice of an official bear market, and I wouldn't be surprised if we went into that for three quick and main reasons. The first is that we haven't had retail capitulation yet, and I hope we don't have that, but it has not come. We've only had $53 billion of outflows from retail investors, which is only 20% of what they've put in since the second quarter of 2020, and that usually coincides with having a bear market. The second is that the Fed's obviously impulse is to raising rates from here because of inflation, which we can talk more about. And the third is that valuations still are pricing in a lot of good news, because while we've had this correction, they're still at the 80 to 90th percentile versus history. And so that, to me, skews some risk towards the downside. But therein, of course, lies opportunity. I don't want people to panic, because a lot of wealth gets destroyed that way. We would be stepping in at these levels with a long-term horizon.
What's long-term? Because actually, it could take time for these markets to work through each other.
It really could. And I would say several years. And I think that's a very reasonable time horizon for most investors. So the key is to stay very clinical, to stay committed to markets, to use these opportunities when others are selling, to be buying. And I think what you're going to see from here is a lot of differentiation at the franchise level, because it's going to take great balance sheets and great management teams to navigate through the current environment. You can find those companies. I think there could be tremendous upside from here.
Katie, what do you do with China right now? So do you add to your investment strategy in China over the next 12 months?
There's a lot of talk about China at Davos. Many people calling it uninvestable. You know what the last thing we all called uninvestable was? Energy. So I think we should be careful when we
Is that a lead indicator? Davos said it's uninvestable.
But I want to be balanced on the point. It's still the world's second largest economy, and of all of the bad news out there, inflation in the U.S., this very tragic ground war that Russia has inflicted on Ukraine, and what's happening in China with the zero COVID policy, it's the last that I actually have the most confidence will resolve itself. I don't know the exact time frame, but this country will reopen. And there's also a possibility that they reopen and that they stimulate the economy. There's other surely challenges facing China, but I would mitigate that by saying valuations have come in by 40%, and most of the market's on a 10 times price to earnings multiple. If you're selective about what assets to own, companies that are on the right side of the government, for example, I think actually there are interesting opportunities there.
So how do you play it? Through international? Do you go direct to some of the A shares in China, or do you play it through international players?
Well, we run a lot of emerging markets exposure for our clients, and China is about half that index. So we invest both in the Hong Kong listed shares and the A shares, and we're very selective about what companies to own. So you want to own things that are driving climate transition. And I also think there's an interesting opportunity in companies driving digitalization in China. They've been sold off with all the tech regulation, but for example, we own Kingdee Software, which is a digitalization provider to small, medium enterprises in China, outside the crosshairs of government intervention, and trading at a substantial discount to what the same company would trade in the US. So I would just like people to consider the possibility that yes, there's a lot of bad news, but there's also a very wide margin of safety, and to be balanced and thinking about exposure to that country.
Is there anything else, Katie, that actually that you see an opportunity? Because, as you say, some investors just don't have the appetite for it, right? They look at the headlines and they say, instead of going into this, I go into something that feels safer.
Right now, it feels like none of them like equities based.
Fair, yeah, that's very true.
So I do think they should be stepping into equities in general for that long-term wealth creation. The other thing I think people are very fearful of at this conference, which actually I think does create idiosyncratic opportunities, is deglobalization, which ultimately is very inflationary. But if, again, you look at where the opportunities lie, I think there's going to be incredible opportunities for certain countries and companies.
So, how do you play dollar? The dollar rally kind of reprices everything, especially on some of the emerging markets that have structural concerns.
Yeah, I think that, the dollar is likely to be strong for some period of time, given the course that the Fed is on. And so many of our clients are dollar-based clients. but we still do believe in the benefits of diversification for the long term. And I would just end by saying, going back to the point of globalization and where people may be, more worried than they need to be, if you look for opportunities and you're not so worried about the next move on the dollar, I do think there are very interesting opportunities in countries that will be beneficiaries of people moving away from Chinese supply chains. India, Vietnam, Mexico, we're invested in everything from small cap chemical specialty companies in India to Mexican warehouses that will actually be the beneficiaries of moving some of those supply chains over, as well as, of course, the build out of semi-supply chains in the U.S. We're invested in semi-equipment manufacturers.
Katie, thank you so much for all of the insight today. Katie Koch there, Goldman Sachs Chief Investment Officer for Public Market Equity. Now, coming up, storm clouds over the U.S. economy may dissipate. That's according to the JPMorgan Chief Executive Jamie Dimon. We'll discuss that next. And this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua at the World Economic Forum here in Davos, Switzerland. Now, JPMorgan held its first investor day in more than 2 years yesterday. The chief executive, Jamie Dimon, was on the defensive over the lender's expenses, strategy, and shareholder communication. But he was bullish on the U.S. economy. Well, here to discuss more is Bloomberg's Charlie Wells. So, Charlie, Jamie Dimon also speaking to Bloomberg TV just 15 days ago. What were the other takeaways from the gathering?
Yes, Francine, so very interesting. JPMorgan has been on defensive over the past 5 months or so. Its share price has really taken a beating in the markets, and that really has been over the issue of expenses. So on a fairly routine conference call in January, unexpected expenses were disclosed, and analysts have been wondering about those for the past few months and asking for more clarity. Well, they got that yesterday with Jamie Dimon explaining that the bank is going to maintain a very disciplined expense strategy, explaining some of its acquisitions, and also announcing the hiring of 1,300 wealth managers as it seeks to boost its business in that area.
So we saw JPMorgan's share price rise yesterday by the most since November 2020. Was that news of the bank's expense discipline and investments?
Yeah, so there was a lot at stake here, right? The bank really needed to communicate that expense transparency. But of course, Dimon did make those positive comments that you mentioned about the state of the U.S. economy a little bit more bullish than I think many people may have expected. You're getting a little poetic there, saying that, the threats facing the U.S. economy are a little bit like storm clouds. And the thing about storm clouds is that they can dissipate. And that seemed to have a positive impact, not just on JPMorgan's share price, but also on bank shares across the board. So JPMorgan, the top 5 performer in the S&P 500 yesterday, Citigroup right behind it, the 6th performer, and Bank of America, number 8. So, positive news across the board for the banking sector.
So Charlie, they basically convinced investors.
Francine, you know better than pretty much anyone in this business that Jamie Dimon is an excellent communicator. He is good at simplifying a story and making it clear to the audience. And that really seems to be what he did yesterday. He talked about the ABCs of businesses that don't do well. He talked about good expenses versus bad expenses. And of course, he did use that slightly zen statement about storm clouds.
Yeah, the poet that is Jamie Dimon. Charlie, thank you so much. Charlie Wells there on the very latest from JPMorgan. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller, Kailey Leinz in New York, Anna Edwards is in London. We'll have plenty more from Davos 2022. This is Bloomberg.
We are not in a panic mode.
We had to digest 3 major shocks, right? The pandemic shock, the war shock, and the energy transition shock.
Our democracy is at risk, and our economic system is at risk.
I don't think a recession is inevitable.
The dollar, we think, is vulnerable on a cyclical basis and also a structural basis.
There's been carnage in public growth stocks.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Tuesday, May 24th. Our top stories today. Snap's shockwave. The parent of Snapchat plunges after slashing its forecast. It's dragging other media stocks down too. China rolls out a new stimulus plan, including tax relief, but UBS and JPMorgan cut their growth forecasts for the Chinese economy. And ECB President Christine Lagarde tells Bloomberg recession is not the central bank's baseline forecast for the euro area. We are live in Davos with more from that Bloomberg exclusive conversation. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Kailey, plenty of news flow coming through from Davos. The vibe in the markets, though, seems to be overly affected, really, by what we heard from Snapchat Snap and their comments that really have affected any company that's exposed to advertising revenue.
Yeah, you're seeing tech really dragging markets down all across the world, Anna. It's true in the U.S., it's true in Europe, and it was true in Asia overnight, where the Hang Seng Tech Index was the big underperformer. It fell about 4 percentage points in the Asian trade. Now, of course, part of that has to do with the drag around sentiment because of Snap, but of course, you also have more broadly the overhang on Chinese and Hong Kong markets of COVID zero policy. You actually had Hong Kong's chief executive Carrie Lam out overnight saying it is very unlikely that those border controls put in place to contain COVID-19 are going to be relaxed during her term. Remember, that term ends at the end of June. And of course, in China, they also are trying to grapple with COVID zero policy on the one hand and potentially offset it with fiscal and monetary stimulus on the other. But investors don't seem convinced by the measures China has rolled out so far. That is reflected in a 2.3% decline for Chinese equities overnight, a Chinese yuan that is the big underperformer in Asian FX, weaker against the dollar by about 1/3 of 1%, right around 668. And of course, iron ore, a commodity sensitive to the Chinese growth story. You saw those futures down about 3.7% in Singapore overnight, Matt.
All right, so some really big moves in Asian markets, and we're looking at some pretty bleak markets here in terms of risk sentiment. S&P futures down 1.5%. Of course, if you're short these markets, then I guess it's reason to celebrate. But investors are buying bonds, stocking up on the perceived security of government debt in order to guard against drops in equities. We're also seeing NYMEX crude move to the downside just a little bit, just under 110 a barrel for Texas Intermediate. You still see, I think, about 113 right now for Brent crude, the global benchmark. And Bitcoin coming down, but only about 0.5%. So still at 29,176, holding around that general 30,000 level. And investors seem to want to buy it, but they're not doing that today because it's so well correlated to risk assets. Anna, what are you seeing in Europe?
Yeah, not buying European stocks either then, Matt. We see European stocks under pressure today, and some of that is to do with the Snap news that we got overnight. Also concern and caution around the growth story out of China, of course. So this is what we have right now for European stocks, in particular the French market down by 1.5%. Let's get to the FX markets, though, because here we see some action as well based on some commentary, some interviews we've been doing here at Bloomberg TV, but also based on some data that has dropped into these markets over the last half hour or so. Firstly, the euro pushing back up against the US dollar. Christine Lagarde speaking to our colleagues in Davos, speaking to Francine Lacqua and saying that a recession is not their baseline case for the Eurozone. And so we see a little bit of an upward move on the euro there. The pound moving in the other direction quite decidedly, down by 0.8% against the US dollar. The services data out of the UK disappointing by 5 points. It's still above 50 on that PMI reading, so still in expansion territory, but dropping pretty fast and coming in much lower than expected. That has investors or market participants dialing back expectations for just how many rate hikes we will see from the Bank of England. Publicis, I picked that one. I could have put WPP, I could have put in a broadcaster, ITV. All of these businesses have one thing in common. They're being influenced by what we heard from Snap yesterday. Anything that is exposed to advertising, being shaken by those comments coming through from that particular business in the tech space over in the United States. And this is Scottish and Southern Energy, down by more than 10%. The FT carrying a report that says that the Treasury might be looking at not just oil and gas companies for some sort of windfall tax, but also looking at power generation businesses. And so we see this and Drax and Centrica and others in that space all falling on that report today, Kailey.
All right, Anna, so already a lot going on this morning, including at Davos, and we'll be getting more interviews from Davos throughout the day. But that is not all that is ahead on this Tuesday. We'll also hear from Fed Chairman Jerome Powell, who'll be speaking in a pre-recorded video at 12 p.m. New York time. Then we'll get more retail earnings with Abercrombie & Fitch, Ralph Lauren, and Nordstrom all reporting. Plus, on the politics front, voting will take place across 5 U.S. states today, including Alabama, Arkansas, Georgia, Minnesota, and Texas. So we'll keep an eye on those primaries. And finally, on the economic data front, we'll get U.S. PMI data at 9:45 a.m. New York time, Matt.
All right, we'll be watching for that, for sure, PMIs in America, considering what we saw, the disappointment in European PMIs. Let's talk about the disappointment, though, in tech. Social media stocks taking a hit as Snap cuts its revenue and profit forecast below the low end of its own previous guidance. We get more from Bloomberg's Laura Wright in London. Laura?
Brutal in pre-market trading. Matt Miller, Snap down almost 30%. Other social media names taking a hit, mirroring what we saw in after-hours trading. In the last earnings presentation, Snap forecast revenue growth year over year of between 20 and 25%, along with adjusted EBITDA between break-even and $50 million US. Then yesterday, in a memo to employees, Snap's founder and CEO Evan Spiegel stated that due to these deteriorating macroeconomic conditions, revenue and profitability are likely to be below the low end of that guided range. The challenges that Snapchat are facing, however, are not unique. Inflation, interest rate hikes, the war in Ukraine, those Apple privacy changes, and these myriad of headwinds mean that companies reliant on advertising revenues, such as social media platforms, are now vulnerable. Nasdaq 100 futures trading down around 2% this morning. The outlook pretty brutal for the tech sector. For the first time in 15 years, U.S. value is now outperforming U.S. growth. And I have a chart for our radio listeners that shows that only 12% of stocks on the Nasdaq 100 are trading above their 200-day moving average. Investors, they want to see returns and have limited appetite for expensive tech names like Snapchat, which currently trades at 51 times forward earnings.
Yeah, valuations have come in quite a bit, but a lot of these stocks are still quite expensive, relatively speaking. Thank you so much to Bloomberg's Laura Wright. Now turning to Europe, ECB President Christine Lagarde rejected the idea that the euro area is heading for a recession. She spoke to Bloomberg's Francine Lacqua exclusively earlier at the World Economic Forum in Davos.
We don't have that as a baseline. You must have heard that sentence a million times, which is why we also do scenarios, and we have the negative, the adverse, the various alternatives there on the basis of hypotheticals such as boycott of oil, interruption of gas supply that clearly would have a significant impact on the economy. But for the moment, we are not seeing a recession in the euro area.
Joining us now from Davos is Bloomberg's Francine Lacqua. Francine, great interview. How does what you heard from Madame Lagarde track with what her colleagues on the ECB are saying, as well as what you're hearing from the other great business and economic minds at Davos?
Well, Kelly, it was really interesting because this was the first time under the presidency of Christine Lagarde that we had a president writing a blog and saying, this is where we are now in the economy. This is what interest rates will do. This is when we'll hike. And this is where we're expecting to be in a couple of quarters. So it was a real, very detailed roadmap of what's coming ahead. Now, the critics will say this is a way for her to front run her own hawks. So the people that want her to be more aggressive on interest rates because she's laid it out to the markets. Others will say, well, this means that there's some kind of consensus within the Governing Council of the European EC Central Bank. So the question now is there a trade-off between inflation and growth? We also spoke to the French governor, and of course he said absolutely not, because the ECB has one mandate and they have to stick to that. And then the other question, if they're no longer negative rates in September, does it mean that we could see positive rate? I know it's nuances and it's really in the detail, but this changes everything for the banks here in Davos.
Yeah, and the euro, meanwhile, fights back then, clawing back some of that lost ground in previous weeks against the US dollar. Francine, thank you very much. Bloomberg's Francine Lacqua over there in Davos. We'll be back with Francine and back to Davos shortly. Back to the news flow overnight, though. China has rolled out a broad package of measures to support businesses and stimulate demand. That's as it seeks to offset the damage from COVID lockdowns on the world's second largest economy. Bloomberg's Tom McKenzie has the latest for us. And Tom, we see the Chinese coming forward with a package of not just 31, 32, but 33 measures to try to support the Chinese economy, but some big banks taking down their growth forecasts.
Yeah, absolutely. In terms of the measures, finally, we have some detail fleshing out the rhetoric that we've heard from policymakers out of Beijing in the last few weeks. A 33-point plan, in fact, from the State Council, including tax cuts worth around $21 billion US, support for the airlines, obviously very badly hit, support for the railways, infrastructure spending around railways, and also tax cuts for autos. So if you purchase a car now, you get a bit of a tax cut on the back of that. But economists within China, some very vocal ones, are saying, look, you need more support for households, more support for individuals, including cash handouts. That has not yet come. And of course, a lot of this is down to the fact that the restrictions remain in place in cities like Shanghai and elsewhere in China. Bear in mind, you can cut taxes on autos, but not a single car was sold in Shanghai in the month of April. Wow. Tying into what you've said, this is why you've got the likes of JPMorgan and UBS downgrading their forecasts for growth for China, UBS cutting to 3% on the back of that lack of clarity. You can have all these measures, but until there's clarity and that lack of uncertainty in terms of what is happening in COVID-0, the pressure will remain on this economy.
Not a single car sold in Shanghai in the whole month. How many people live in Shanghai?
You've got around 25 to 30 million people living in Shanghai. Around 25 million, I think.
Unbelievable. Tom, thanks so much for that. Bloomberg's Tom McKenzie rounding up the China situation for us. Let's talk, though, about the Biden administration. Trade representative for the U.S. says the U.S. has to be strategic when it comes to dealing with tariffs on Chinese goods, the possibility of lifting those tariffs. This comes after President Biden said he would consider removing some of the Trump-era laws. Catherine Tai spoke with Bloomberg yesterday.
With respect to the tariffs, our approach, as with everything in this relationship, is to be strategic. We have to keep our eye on the ball in terms of how to effectively realign the U.S.-China trade and economic relationship.
Meanwhile, of course, President Biden stoked tensions with China with a vow to defend Taiwan militarily. The White House walked back those remarks a bit, saying the president was only promising Ukraine-like military weapons aid. Dan Tenkate, Bloomberg Asia government managing editor, joins us now in Hong Kong for more. You know, Dan, the idea that we would send weapons is already a little bit controversial, but did it seem like the president was suggesting we would actually interact militarily if China were to attack Taiwan?
Yeah, I mean, that was kind of the stunning thing about the exchange. It was with a reporter who basically said clearly, you know, you've stayed out of Ukraine militarily. Will you go into Taiwan militarily if China attacks? And Biden said, yes, you know, we made a commitment. So, you know, that's what spurred all the headlines around the globe saying that. And, it would represent a big shift in American policy. You know, there's always this debate about, you know, strategic ambiguity versus strategic clarity. And the U.S. policy for years has been, we won't tell you exactly if we're going to go in or not. So it looked like a policy change at the moment. The White House quickly walked it back, and now everyone's just trying to figure out, you know, was he doing it deliberately? Was it a gaffe? You know, what's going on here?
Yeah, no doubt there will continue to be comments around this, Dan. Let me also take you to what we've heard from the Quad, the so-called Quad meetings. So President Biden making his first trip to Asia and keen, of course, to meet with other members of what are known as the Quad, a four-nation security grouping the US, Japan, India, and Australia. What have we heard from those meetings?
Yeah, well, you had a big symbolic showing, you know, the new Japanese Prime Minister Modi, of course, in India, the new Australian Prime Minister just elected over the weekend. Out of that, you know, we had the most substantive thing was probably, you know, an agreement to shine a spotlight on all the Chinese fishing movements around the South China Sea, basically have a big radar going from the Indian Ocean to the South China Sea and beyond. So, you know, the point is that now they're trying to put really concrete measures on this new, relatively new grouping, you know, that is trying to counter China and show democracies in the region, you know, another path, another alternative to dealing with Beijing.
Yeah, India's relationship with the others in that grouping, one to watch for sure. Thanks very much, Dan. Bloomberg's Dan Tenkate joining us there from Hong Kong with the latest on the geopolitics. Coming up, we'll get back to the markets. Jimmy Conway, head of EMEA equity trading strategy at Citigroup Global Markets, joins us. How concerned is he about companies that have advertising revenue at this point? We'll head back to Davos and we'll hear from Dr. Seth Berkley, CEO of Gavi, the Vaccine Alliance. Just how have they been coping with the COVID-19 pandemic? What is still left to do there? Plus, more from our exclusive interview with the ECB President, Christine Lagarde. We'll bring that to you later in the programme. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz here in New York. Anna Edwards with us out of London. We want to get back, though, to Switzerland in Davos. Bloomberg's Francine Lacqua is sitting down with Dr. Seth Berkley, CEO of Gavi, the Vaccine Alliance. Francine?
Yeah, thanks so much, Matt. Doctor, thank you for joining us. I have 1,000,001 questions on vaccines and COVID and where we are now. Now, you've said that every country at the moment can actually meet their demand for the vaccines or has enough supply to vaccinate the population. The problem is demand. Where are you seeing the most issues with people not wanting to get a booster or not wanting to get vaccinated, full stop?
So, I mean, we've really changed. So one of the exciting things that's happened, I mean, COVAX has delivered 1.5 billion doses to 145 countries. Coverage rates, 46% in low and lower middle income countries. Global average around 60%. So still inequities. Yep. We have to work on that. But that hides the fact that there are still low coverage countries. So there were in January 34 countries with less than 10% coverage. Today that's 18, but 14 of those 18 are fragile countries. And so what that requires is really hard work on trying to help deliver in those settings, working to build sustainable and resilient delivery systems. And that's where the challenge is right now. But as you say, we do have enough vaccines now to make those available for primary doses as well as boosters if countries want them.
I mean, did you ever think we'd be in a situation, so almost June 2022, where you have half of Europe, the US, which is acting as if there was no COVID right now because we're over it, and China, which is still almost in full lockdown?
I think it's really a challenge right now. Complacency is so strong. Many countries have gone from lockdowns to opening football stadiums with people cheering, you know, in packed stadiums without masks. And that is a problem. Now, of course, if you're in a country that has very high vaccine coverage, we still have to worry. People do still get sick and die. But in general, the vaccines protect pretty well against severe disease and death. So they have more ability to do this, but that's not necessarily true in countries that have low coverage. And that's why covering the healthcare workers, the elderly, and those with comorbidities is absolutely critical.
How close are we to this next generation vaccine that actually stops infection, full stop, stops transmission?
I mean, you know, there's a lot of research going on. There's now a couple of dozen vaccines that have been approved, but there's 180-odd vaccines that are in development, many of which are looking at mucosal immunity. That's, you know, getting it in the mouth and nose to protect there. Different types of vaccines, trying to diversify and get a broader immune response. But right now, there isn't one right available here. And so the ones we have continue to work well. But of course, we don't know that that's going to be true for the next variant or the variant after that. And that's what we have to continue to be prepared for.
But how close do you think? I mean, could we be a year away, actually, from this non-transmission vaccine? And does it change if that people want to get vaccinated with that? Because they think, if I don't catch it at all, then this is, you know, I'll go and get vaccinated for that.
Of course, we'd like to have a vaccine that blocks transmission of disease, like a measles vaccine. Very effective at doing both of those. The challenge right now is we don't have any, and it's hard to predict exactly when because we have to wait for the data to see, you know, what happens here. But I have no doubt, I have faith in science, and I have no doubt that science will solve it. The challenge then will be getting it out to the rest of the world. But you know, we've made 12 billion doses. You know, who would have thought that was possible? You know, many times more than what the globe uses of vaccines. And so industry has really stepped up.
Should we worry about monkeypox?
Well, I mean, the thing about monkeypox is if this was in one of the endemic countries, the answer is you do worry about it because it's an infectious disease. It can spread. What's strange here is the fact that it's now in, more than a dozen countries and hundreds of cases, and we don't yet have a link between them. And until that link is worked out, I think we have to watch it with caution. We do have vaccines and we have drugs that work on that agent, and it's not highly transmissible. That's right. It's in the family. It's not smallpox. It's in that family of viruses, and you can use a modified vaccine, Ankara, which is a type of vaccine against smallpox that will provide protection for that, and there are some antivirals as well. So, I mean, the thing here is it's not transmissible in the same way, and so I don't think we're not talking about another COVID pandemic.
I mean, COVID, this is an important question. If you look at COVID and the fact, the relationship that it's changed between us and actually our health, does it make us more likely to see the next pandemic because we worry, even monkeypox and things like that? Or do people write it off and saying, oh, this is, once again, the people of this world trying to worry us about what's coming up next?
I mean, this is the challenge. We have had a series of panics, neglect, panics, neglect, panics, neglect. I mean, in Davos here and after the 2015 Ebola outbreak, it was #1 on the risk registry of what people were concerned about. The next year it was gone. And that's really the challenge. What we need to do is move to a place where in peacetime, when there isn't a pandemic, to continue to invest, to build the systems, to make sure we're prepared for the next one, because I think we've now seen $12 trillion worth of damage from this little virus. And so I think what the message has to be is let's figure out how to make the world more prepared. And that is a topic here.
Seth Berkley, thank you so much for joining us here in Davos for day 2. That was, of course, Kailey, the chief executive of Gavi.
All right, Bloomberg's Francine Lacqua joining us with that interview with Dr. Seth Berkley. Thank you so much from Davos. Now, keeping you up to date with news from elsewhere around the world, here's the first word. Kansas City Fed President Esther George expects the central bank to raise interest rates by 2% by August. To 2% by August, I should say. After that, she says more tightening will be guided by how fast inflation cools off. George has been known as a longtime policy hawk who more recently moved to the center. In China, the top official for pandemic control has shifted her attention from Shanghai to Beijing. That's raising pressure on the capital to contain a lengthy outbreak. And it may signal that harsher restrictions are on the way. Chinese Health Czar Sun Qianlan urged authorities in Beijing to implement more measures tied to the COVID-0 approach. Broadcom could announce an agreement to acquire cloud computing company VMware as soon as this week. VMware shares rose 25% on Monday after Bloomberg reported that the talks were underway. The company currently has a market valuation of more than $50 billion. The Broadcom offer is likely to be mostly in the form of stock, but would include a large cash element. And Zoom is signaling it can expand beyond its consumer-friendly video software that helped the company to a pandemic boom. The company projected revenue would increase about 10% in the current quarter. That's better than estimates, but still its slowest quarterly sales growth ever. Zoom is now focusing more on business customers. And of course, Matt, this is really just emblematic of the stay-at-home trades that were so popular during the pandemic unwinding in a massive way. I just checked out Zoom share price since its peak in October of 2020. This stock is now down 84%, and it's not alone in facing that kind of pain.
Yeah, still shocking declines there. On the other hand, I feel like Zoom is doing a little bit better than, say, a Snap because they don't rely on the advertising, right? That's why they're switching towards business clients. And Anna, of course, we spend a lot of time on Zoom every day.
Yeah, and I feel it's become a verb. Whenever you become a verb, you're into some sort of different territory, aren't you? But it was interesting to see them navigate the move to hybrid working, because if that's the reality that many of us in financial services, at least, are going to be facing, then that is something that, Zoom still plays a role in. And there was some commentary on that coming through from the company, which was interesting to note, and actually pushed their share price up in the immediate aftermath of the results. But you're right, Katie, did fall back afterwards. When we come back, we'll talk about what we've heard from tech and media stocks. Jimmy Conway, head of EMEA Equity Trading Strategy at Citigroup Global Markets, joins us. What did he make of the vibe coming through from Snap? Also, banks in focus this morning after Jamie Dimon speaks out. We'll talk about that next. This is Bloomberg. Bloomberg Surveillance Early Edition. Here's what you need to know. Snap's shockwave, the parent of Snapchat, plunges after slashing its forecast. It's dragging other media stocks down too. Facebook owner Meta Platforms and Google parent Alphabet are among the losers. China rolls out a new stimulus plan, including tax relief. It's mostly aimed at businesses struggling with COVID lockdowns. But UBS and JPMorgan cut their growth forecasts for the Chinese economy. And ECB President Christine Lagarde tells Bloomberg recession is not the central bank's baseline forecast for the euro area. We will bring you more of Lagarde's comments from that Bloomberg exclusive interview in Davos. Welcome back, everybody. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Matt, European equity markets taking a pretty gloomy look at things this morning.
Yeah, it's pretty gloomy here as well, but not nearly as bad as the end of last week. I can't believe I missed that. I'm glad to be back in the markets, although S&P futures are down 1.4% right now. Investors are buying bonds in order to maybe hedge against those risk drops a little bit. NYMEX crude coming down 0.5% to 109.73, and there's a risk-off indicator here in Bitcoin as well, but not much of a move really. This is the price change from midnight, 29,251. It's really all about Snap, right? And over the last 10 years, I've never figured out Snap. I still don't really understand it. And even more today, Kailey, like, isn't it just about the kids, you know, not listening to their parents, snapping at the dinner table? Like, why would there be an advertising slowdown for the kids? They're never going to stop.
Well, if you ask Snapchat, Matt, the issue is geopolitics, inflation, supply chain, all of these things that mean companies are shifting around their advertising budgets. I guess if you're facing higher input costs, you're having a little bit more difficulty passing those on to the end consumer. Maybe you're going to cut back on some of those advertisements. But is this kind of a situation like we see with retail sometimes when they blame the weather? And this is just a company that is facing slowing growth, and it's easy to blame the macroeconomic environment. That's something we can dig into later on this hour when we talk about this a bit more. But nonetheless, Snap shares are receiving a brutal punishment in pre-market trading this morning, down a whopping 28% and taking some of those social media peers down with them. The likes of Meta Platforms, which is the parent company of Facebook, down 7%. Pinterest is down more than 13%. One of the more positive stories out there, though, is Zoom. It reported earnings after the bell yesterday. Its second quarter revenue forecast topped expectations. That sent the stock up as much as 21% in the after hours trade. In the early hours trade this morning, the gain is not that large, up just about 6.5%. So maybe investors still questioning the long-term trajectory of this stock in particular, because as I said earlier, Anna, still down 84% from its peak in 2020.
Yeah, impressive of sorts. Kailey, let's have a look at what we've got here on European equity markets then. And this negativity that we're seeing in US futures, the Matt was just going through, that's definitely reflected here in Europe. And some of the stories that Kailey was referencing there around Snap having an impact here. So Stocks Europe 600 down by just over 1%. The pound is really in retreat today, down by 0.75% against the US dollar. 124.94 is where we trade on cable. And this has to do with some of the really negative data we got on services. That services PMI number disappointing by 5 points, and it was still above 50, so still in expansion territory, but much lower than had been anticipated. Just how quickly is the UK economy slowing down with the cost of living crisis front and centre, and how many rate hikes does it mean there will be room for from the Bank of England? And the market seems to be reassessing that as we go through this morning. Gilt markets reflecting that too. Here's the read across into Snap. WPP advertising giant down by 3.9%. It seemed there was enough in that Snap release to just raise a few questions about whether businesses are going to continue to spend on advertising. We know when geopolitics is tough, that can be tough too. Scottish and Southern Energy down by 9%, and this reflects falls across the sector. There are other companies in this power generating sector, not just in the UK, but actually into other parts of Europe that have also been hit by these reports, suggesting we could see windfall taxes on this kind of business, as well as the consideration as to whether to windfall tax oil and gas players, Matt.
That, I think, a fascinating story, and you got to wonder how much that incentivizes those kind of businesses to invest the next time you really need them. Let's get to a bank's, or a bank CEO's view on the market, specifically UBS's Ralph Hamers. He expects more clarity in global markets within the next 3 months and says he is optimistic about the direction of rates in Europe. He spoke to us in the World Economic Forum in Davos.
Rates getting into positive territory is a good thing, in my view. We can make bigger steps there. Real rates are still negative. Therefore, I do think that from a policy perspective, it may not be as bad to make those moves. And it builds you a buffer for ammunition when you need it again.
Jimmy Conway joins us, head of EMEA equity trading strategy at Citigroup Global Markets. And I guess, the main question, Jimmy, which you must get over the last few days and weeks is, have we fallen far enough yet? Have we priced in the increases we're expecting from central banks, the effects of the inflation that we've seen, and the expectation for slowing down growth?
I think it depends on which one of those you want to pick apart. I think, in terms of the derating of the market, we've clearly done it, chopped a huge amount of wood. I think in terms of the tightening, we're getting to that point whereby we're sort of seeing an inflection point. So, for example, the correlation between the equity market and the bond market is breaking down. That was a huge problem for Q1. I think what is a little bit more problematic is the extent of the unwind. You've got a decade's worth of inflows into US equities, which I think is now a little bit under pressure. We see evidence of that in things like, the realized volatility of the NASDAQ versus, for example, the bank sector in Europe. And so I think we're at that stage now where the unwind and credit risk are what could take us a little bit further. So those are the things that we are paying most attention to.
So in that kind of environment, Jimmy, I'm wondering if it's a dips are safe to buy or you want to sell the rips. Our market producer, Pete, pointing out to me this morning after the last 10 1% plus gains on the S&P 500, 9 out of 10 times the next day the index is lower on average by about 1.4%. And lo and behold, after yesterday's gains, S&P futures are down about 1.4%. When will sell the rips stop being the play?
I think when you see the inflection point from the Fed, we've lived for the last decade in an environment where we've always talked about the Fed put, and that's largely because inflation hasn't really troubled the waters. Now, I think the inverse is true. Every time we get up to 4,200 in the S&P, for example, it seems that we're confronted with hawkish Fed speak, and so that free put has almost become. Free put for those who want to be long and buy the dip has become a free call almost for those who want to stay short the market. So I think you have to wait until you've seen, firstly, the clearing price for credit risk, and secondly, the Fed inflection point. And those two are obviously quite hard to time.
Is the Fed put now exclusively for credit, not for the equity market, Jimmy?
No, I don't think so. I mean, I think that's the big problem, right? Is it there for credit at all as well, right? The Fed is, as many other central banks are, is making it very explicit that their mandate and their priority is to get inflation under control. And it depends what are the sort of victims of that process. I think credit is a more important feature for the Fed. I don't think they want to get to the point whereby we have a credit crisis, but that's a very, very difficult thing to control and time, especially with secondary market liquidity not being great.
Jimmy, good morning. Are you still looking for inflation hedges at this point, or are you looking at strategies that protect in a downturn? Clearly, central banks are still very focused on the inflation fight, but what should the strategy look like? Should it focus on inflation fighting or on growth slowdown?
I think you're still going to see support for commodity inflation. I think that's still an interesting pocket. And in Europe in particular, there's a real problem because it's an underweight, right? We've had lots and years and years of ESG expansion and various reasons why it's been difficult to commit capital to that sector. And indeed, the sector hasn't done any of its own capex. Strategically, beyond that, inflation hedges, yes, there's sectors like the banks, which I think are just fundamentally very cheap in an inflationary environment. But really what we're looking at is balance sheet.
Okay. When I look at the European stock universe, though, to your point, energy stocks up by 22% year to date, where, a lot of other sectors, obviously retail, consumer products, all of these falling drastically. So energy really does stand out. There's a lot of politics around whether that we might see kind of windfall taxes being applied to those businesses in power generation businesses. Clearly, we don't know where that politics will take us, but I guess that's still a risk. That's an increasing risk, perhaps.
Yeah, look, I mean, it's done very well year to date, but look at it relative to the broader market. It's still below where we were pre-pandemic. And then look at where crude is. And then I think throw into the equation that these companies, many of which have sort of been told by the market for years that you have no terminal value. You're dinosaurs, you're on your way out. So what do? Well, you get yourself incredibly lean, right? The operational gearing. I mean, look at the free cash flow that these guys have. And I think that's very, very difficult to overlook, especially in a world where the expediency of needing more carbon-type products is perhaps leading investors back to being able to commit capital to them again. So, yep, I think there are short-term pitfalls like the ones you've mentioned, but on a sort of 2 to 3 year outlook, it's very hard not to see this underweight being addressed more.
And, I mean, when you hear about these windfall taxes, and we've seen something similar here in the U.S. where the government is going to just attack these guys when they're down and then, tax them when they're up. It's got to make you shy away from investing. It's got to make them shy away from investing.
Yeah, I think that's right. I think, I'm no sort of political expert by any means, but if you think about the rational economic decision that you would make as one of these corporates, you have to be, these are not, it's not like a software program, right? It takes a while for these projects to come to fruition. You're looking at 2, 3, 4, 5 year plus type projects. So I think trying to guarantee that the return on investment is in excess of your cost of equity, which is, I guess, the equation as to do I do this or do I buy my shares back? That's still very problematic without certain assurances. And I would imagine that, headlines along the lines of what we've seen this morning make that calculus even more problematic, shall we say.
Jimmy, thanks very much. Thanks for joining us. Jimmy Conway of Citigroup Global Markets, giving us his thoughts on the equity market picture at this point. Coming up, we'll be back to the tech names. Snap shocks the markets. The social media company is down in pre-market trading and dragging others with it. More next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, Bank of America CEO Brian Moynihan. That's at 11 a.m. in New York, 4 p.m. in London. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Well, let's get back to Snap, which cut its forecast below the bottom end of its guidance. That warning adding to woes for the sector, which already is reeling amid stalling user growth. And Snap shares are down nearly 30% in pre-market trading at this point. Joining us now for more is Matthew Bloxham of Bloomberg Intelligence. So, Matt, is this kind of the thing where it's really easy to blame supply chain issues and inflation for the reason why you're coming up short, and this is just a company that has seen the peak of its growth already? Or can we really, really blame those macroeconomic headwinds?
I think it's a mixture of the two, to be honest. I think there's a lot going on in the digital ad space right now with the kind of move to first-party data that's kind of making it harder for those digital campaigns to run as effective as they did before. But clearly we are in the face of a big economic slowdown, inflationary pressures on advertisers that will be squeezing their budgets, and advertising is one of the first things to go if CPG companies are looking to protect their margins. So I think it's a mixture of things going on here.
We're seeing, Matt, good morning. We're seeing some quite big moves and some quite big European companies on this front, aren't we? WPP, Publicis, both down today in the advertising space. ITV, the broadcaster, down. It almost as if the market was primed to look for this kind of negativity. We know that things in an inflation environment, as you say, might get tough for those exposed to advertising.
Yeah, that's right. We called out on the ITV results recently that we thought consensus for ad revenue was a bit optimistic this year. We were surprised that the ad agencies upped their revenue guidance for this year on the back of a strong Q1, because it seemed obvious that things were going to get tougher. So it's not surprising to see those shares come under a bit of pressure. But I think that the signs are already there that these guys are going to face tougher, definitely second half of this year on the revenue side.
Matt, we heard from Snapchat that the supply chain is causing a problem in their advertising numbers. I guess I can make the connection, but can you help me through that? How does the supply chain of physical goods end up affecting advertising revenue?
Well, my interpretation with them is that essentially that they are very much a direct response platform, that they're looking to help brands drive sales. And if those brands don't have goods to sell and the supply's dried up, then there's less reason to actually spend dollars in trying to sell something you can't put in the hands of customers. So that's my interpretation of it. Ironically, you'd think as ad budgets come under pressure through this year, actually most of the remaining budget will go towards sales activation. But yeah, if you've kind of got this kind of combination of weakening demand and constrained supply, then it puts brands in a difficult place about where to put their ad dollars.
And finally, Matt, there's obviously a lot of conversation about a potential recession coming in the next, say, 18 months. Is this something we can expect only will get worse for these social media companies as time goes on and as policy gets tighter?
Yeah, I think so. I think clearly a lot of CPG companies in particular that are big advertisers are looking again at their budgets. Their margins are under pressure. As I said earlier, the ad spend is something they'll look at as one of the first things to go. So I think as the kind of squeeze on spending mounts for consumers, I think you're potentially looking at more pressure on budgets overall and for that whole kind of advertising value chain.
Matt, thanks very much. Matthew Bloxham of Bloomberg Intelligence. Thanks for bringing us the details there. Coming up on the programme, a turning point for monetary policy. More from our exclusive interview with the ECB President, Christine Lagarde. She spoke to the team in Davos. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. Now, Christine Lagarde is not in panic mode, she says. We spoke to the ECB president exclusively from the World Economic Forum in Davos. And my colleague Francine Lacqua asked about the path ahead.
We are at a turning point. We have all the components in place for that. We are turning our back to negative interest rates. We are moving very likely into positive territory at the end of the third quarter. And then, of course, we will calibrate. We will establish exactly by how much we want to do that.
When you talk about, of course, no longer negative rates, has the market quite understood that this could mean also positive rates?
Well, when you're out of negative, you can be at zero, you can be slightly above zero. This is something that we will determine on the basis of our projections, on the basis of our forward guidance. I think that there are good reasons to believe that all three conditions will be satisfied in June and further on during the summer.
Where are we in the third quarter? Could we be, above zero in terms of interest rates? Is that kind of the trajectory?
This is what I'm saying I stick to. We will be out of negative interest rates, most likely before the end of the third quarter.
How do you see inflation developing from now? I mean, again, there's so many unknowns because of the war.
There are lots of forces, and some of them, counteracting against each other. You have the war, which in and of itself is an absolute drama and has massive economic impacts, not just in Ukraine and eventually in Russia, but for the rest of the world. We have energy prices, which have gone up significantly and represents a big chunk of inflation. We have food prices. I mean, there's a whole series of things that are weighing on growth down and pushing inflation up.
How likely is it that the Eurozone goes into recession?
We don't have that as a baseline. You must have heard that sentence a million times, which is why we also do scenarios. And we have the negative, the adverse, the various alternatives there on the basis of hypotheticals such as boycott of oil, interruption of gas supply that clearly would have a significant impact on the economy. But for the moment, we are not seeing a recession in the euro area.
All right, an exclusive interview with the ECB president, Christine Lagarde in Davos, who doesn't see a recession, I should say, as her base case, which is comforting. Bloomberg's markets correspondent Kriti Gupta joins us now on set with her chart of the day, and I'm excited.
I'm excited.
We don't usually get chart of the day this early.
But you get a single best chart from Tom Keene, so we're doing something similar here. I want to marry the two big stories of the morning. These comments from Christine Lagarde with the Snapchat earnings that we saw after the bell last night. But I want to macro it and look at the Solactive Social Media Index. Essentially, this is an index that includes the likes of Facebook, now Meta, Twitter, Snapchat, and also the other social media names from around the world. And what I'm really trying to get at here is to look at it from an ad spend kind of point of view, given that ad spend can be a proxy for global growth. And what you're seeing basically for our radio audience is a 10-year chart where you do see some kind of, I don't want to call it a boom and bust type cycle, but certainly a boom cycle where you see these massive gains. It kind of stalls out as the economy stalls out, and it goes over and over again.
But it comes back. So these are social media companies that shot up during the pandemic because we were all locked down and locked in to Facebook and Snapchat and Twitter, etc. And the idea is now that we can leave the house again, we don't need to be stuck to our devices.
Well, that's part of it. The other part of it is simply the fear that's baked into the market, and this is the macro part of it, because remember, a lot of this is based on ad spend. You're not going to spend money on marketing, on advertising, if you don't think the consumer is actively going to spend those dollars. And right now, that seems to be the fear that's not just in Snapchat earnings, but across the board, even outside of social media.
Yeah, it's a great point, and I loved Matthew Bloxham's point, which is that especially if these people don't have anything, if these companies don't have anything to sell because of supply chain problems, why would they buy ads?
Yeah.
All right, Kriti Gupta with the chart of the day. Thank you very much for that. Let's get to what else we're watching, and I'm focused really on retail earnings today. Remember the retail disaster that led to last week's well, mini crash, I think is a fair way to put it in terms of risk assets. Now we have a ton more retailers on the higher end, or at least what I perceive to be the higher end. So you've got Ralph Lauren coming out, Anna, with earnings. You've got Nordstrom coming out with earnings, and companies like Best Buy, and I think most importantly, Petco. Now, the reason is Dan Curtis, who was one of our producers in London, said, look, if people are taking fewer food selfies, I think we have a full screen of this quote, if people are taking fewer food selfies, the world is a better place. If people are spending less on their pets, well, we're all in trouble. And it's a great point because you don't need SNAP, right? I still haven't figured out what it is, but you do need to buy food for Fido, and if you're not doing that, then times are tough.
You do, but is this, going back to the SNAP story, I mean, is this just the, IRL fighting back? And if in the real world that we've all gone back out into, maybe we don't need quite so many pets? Controversial, but some people got a lot of pets during lockdown.
It's too late, we have the pets.
Yeah, I know, you've got to feed those ones that you've already got, but maybe you don't need another one. I'm just saying. I'm focused on UK eco, and this actually taps into what we've been talking about with Snap and confidence in the future, because we just saw this composite PMI number for the UK, 51.8. That dropped from 58.2 the last time around. That is a big drop, Matt. That is also a big miss because the estimate was 56 or so. How is this reflective of, consumer sentiment weakening in the UK? The gilt markets are already adjusting to lower expectations for hikes from the Bank of England. So this, looking at confidence in the future, is something that we're going to be doing a lot. That is it for the early edition. Surveillance in Davos is ahead. This is Bloomberg.